This episode of Masters of the Market is proudly brought to you by AIA Health with AIA Vitality, health insurance that protects and rewards. To find out more, visit aiahealth.com.au.
To buy when there's blood in the streets, lift up, check under the carpet. Many try but few become master of the market.
Well, Vihari Ross, thanks very much for taking this time and coming on Masters of the Market. Really appreciate you joining the show.
Thanks very much, Chris. I'm happy to be here.
And now trained originally as an actuary, but ended up at Magellan. Do you ever think how life might have been different if you had have gone down the actuarial path?
I do, and I'm pleased I didn't, I have to say. So, I always wanted to do something with numbers, but I wasn't just a maths person, back at school and at university. So I really wanted to combine maths with thinking about life, I suppose. And I really feel, investing proved to be this wonderful combination of the two, where you think about the world around you, everything you see, you do, you consume and interact with is ultimately relevant in some way to how, the prospects of businesses around the world, and combining that with some quantitative skills has actually proven to be a really nice balance for me and my skill set. So I am glad that I didn't end up working as an actuary, I have to say.
And so as head of research at Magellan and also a portfolio manager, you mentioned your grounding in numbers there. How do you go about researching and valuing stocks today, where some of the traditional valuation methods that you would have grown up with may not seem as relevant today as perhaps they were when you started working in the industry?
Yeah, look, it's interesting. I think, valuation does have to always evolve over time, and, understanding what the market is potentially doing in valuing a company is just as important as how you are going to do it, because you're potentially taking a contrarian view to how the market is looking at something. And what I would say is traditionally, at Magellan, we're sort of using, in many ways, similar methods to what we always used, but you have to take, again, what's happening in the world around you into account. So we use, traditional DCF, where we're looking at very long-term prospects of a company. And we also look at what we call our total shareholder return expectation, which is what are the earnings going to be like over 3 to 5 years? What multiple will the market put on that? And therefore, what is the business worth today? Taking that into account. And of course, a big swing factor there, and that this is, affected all companies, is the level of interest rates around that. It's been any long-term chart just has a steady trajectory, lower and lower and lower. And there's lots of reasons for that to be, very valid and true, demographics and tech-based deflation and the sheer amount of debt in the world, that damper on rates as well. And all else equal, if you think of, a company that's growing, 4% per annum, it's linked to economic growth. And all else equal, if rates are lower and that 4% remains intact, that business is worth more. What would have been worth 15 times is worth 20 times or 25 times, depending on the level of rates. But the thing that I always caution people against when it comes to that is, not all companies are created equal here. What is the implication of lower rates for companies?
Yeah.
Usually the implication of a lower rate environment is lower growth as well. Why are rates so low? It's because growth is lower. Inflation is lower, or real growth is lower as well. And so you might say, okay, this company previously was going to be growing at 4% forever, but it's important to question, is it still going to be growing at 4%? Is it linked to that economic activity? And is the growth actually permanently shifted down as well for that business? So those companies aren't actually worth any more than they were before. So while markets have lifted all boats in many cases, that's not necessarily justified across the board from my perspective. Some companies, absolutely. There's a structural growth tailwind sitting behind them, and maybe that 10% shifted to 9%, or the 10% is completely intact. And that business, hand on heart, genuinely is worth more because that cash flow profile hasn't changed. And so you've really seen that play out in a pretty significant way, in the staples and the utility space for the last, really since 2016, when the Fed first had their, reared up the front of the horse saying, oh, hang on a minute, maybe we won't take rates up as much as we thought we would. And you've also seen it for those really high structural growth businesses. But for us, it's not just about, is that multiple justified, but are those cash flows predictable and reliable? And we can talk about this, during this chat, but, with that actuarial background, I like to think about, we're predicting the future here. We've got a crystal ball. And how clear is that crystal ball on this business? What does the distribution curve, to use the actuarial term, look like on this stock? Is it a narrow distribution curve? It's highly linked to economic growth, or it's highly linked to that particular tailwind, and you can really predict what this business is going to look like in 3 years and 4 years and 5 years and beyond. Or the other extreme is this a straight line distribution curve, i.e. that outcome is likely, or that outcome is just as likely, which means you actually have no idea what the business is worth at all. So I would say the thing that hasn't changed is, that discipline around valuation is just as important as it always has been, but understanding the dynamics, the components that go into that valuation, the growth, the market risk premium, which, is impossible to back solve for, as well as a level of rates, sort of understanding all those components are really important in working out which of the stocks that are overvalued and which ones actually look, cheap, despite what the overall level of the market might be.
You mentioned there that the central bank's effectively rising all boats to some level. As an intellectual exercise, have you ever changed the denominator of shares or asset classes in terms of, certainly Rapol has been vocal on this, changing the denominator of the G4 balance sheets, which have been growing at 15% per annum since 2008. Have you done the intellectual exercise of changing the denominator from USD or AUD to central bank balance sheets to see which assets are really going up in value as a percentage of the monetary base versus which are just going up in nominal value because currency is being debased?
Well, I think that's really interesting. Look, I've never done the actual maths on that particular exercise, but it's a really fascinating idea.
So the only two asset classes that have gone up, that have outperformed, entire classes, I mean, Tesla's outperformed, but NASDAQ and Bitcoin are the only two that have outperformed central bank, the G4 central bank balance sheet growth, which when you start looking at everything through that framework, you start to it's intellectually offensive at some level, because when you sit around all day trying to pick stocks, you start to get a feel for how much tailwind, I guess, there is in the system from the central bank stimulus being pumped in.
Yeah, that's a really, really good point. And that's the thing. It's really, hopefully cutting through some of the noise around markets, because markets always have noise.
Yeah.
And, as Buffett famously says, in the short term, it's a voting machine. The long term, it's a weighing machine. So what is this business really worth over a long period of time? Happily at Magellan, we're not trying to own the market.
Yeah.
I'm sort of grateful for that each and every day, because we just have to pick, the 25 companies when it comes to the global portfolios, or the 75 companies in the core portfolios that we believe are the best places to be right now, and not having to necessarily worry about the valuation of 2,000 stocks across the broader market. And there's a whole bunch of, business in there which we just don't look at, highly cyclical companies, some of those story, non-profitable story type companies that probably don't have sustainable advantages from our point of view. They're just off the table.
And so talk me through your framework. I know you've got sort of 4 points when looking at a business that are your first points of call when you're ranking the quality of your company. Can you talk us through what that looks like, that framework?
Yeah, absolutely. So when it comes to our process, that first step really is, what are the businesses that deserve to be in the Magellan investment universe? Which are the companies that meet our quality criteria? And only companies that are on that list are ultimately eligible for investment. So there's a whole bunch of companies that just never make it, from an industry point of view, being very commodity exposed, or, for ESG reasons, be it tobacco or, to some defence contractors and things like that don't make it either. But beyond that, we're applying our quality hurdles, which is it's a qualitative view based on a few different criteria. And we have an investment committee, all the senior people in the Magellan investment team, participate in, and then we'll debate these scores as well. The first and most important one is economic moat. Economic moat is literally what is the protection around this business. The business is the castle. What is the width and depth of that moat? What are the protections, the economic protections around this business? Does it have economies of scale? It's a classic one. Can they deliver that product or service to their customer cheaper than everyone else can? And a Costco or someone's a wonderful example of that. Amazon's a good example of that. The scale of that business. And it's interesting if you think about disruption, which is another component we look at, because, there's no gap left for the competitor to come in and offer that good or service cheaper than what you can. Costco also takes a very thin margin. You pay your membership fee, but then you pay very little margin as a customer on the products you buy. That's really difficult to disrupt. You have to have scale in order to do that. Then you might have, a brand, like a Louis Vuitton, like a Gucci, that has incredible pricing power attached to it and has that longevity of desire. Alcohol companies often have that as well, where those products, have been consumed and have been popular, for 100 years and continue to be so, because it sort of often goes hand in hand with economies of scale, because you've grown this amazing juggernaut of a brand, and therefore you can outspend everyone else, on marketing it and things as well. You might have, one of my favorites is network effects. You can imagine where the two sides of the market reinforce each other. A Visa card is a great example of that, where, the more and more card holders you have, then the more and more businesses want to accept the Visa card. And then the more and more Visa cards that are accepted, the more willing you are to have one. So those two sides reinforce each other and they strengthen each other. And I think it's interesting in the case of Visa, especially because it was established in an analog world. Every person was brought on over the course of time to the tune of, $11 trillion in transactions now. And that is actually incredibly to disrupt. In some ways, digital networks are almost easier to disrupt than the original analog ones, because everyone floods to Snapchat, or everyone floods over to Instagram stories, or whatever that happens to be. The adoption of digital technology is a lot faster and can move a lot faster. So of course, there's these different criteria that you might look at. What are the advantages of this business? Let's identify what those advantages are and talk about them. Analysts write, very detailed reports that go into this, and identifying that advantage, that's really important. And then disruption is really around the trend of that moat. Where is that business going, 5 years, 10 years, 20 years into the future? Will this business be stronger over that time period, or does it face threats? And I think it's sort of an obvious thing to say, because of course all businesses face threats all the time. And again, their resilience to those sometimes is a function of how well they react to it. Technology is a classic. As I said, the whole point of technology is something new comes along all the time, and you have to adapt to that and grow, the cash flow that your business generates around, staying ahead of that. And I think that's relevant in healthcare as well, where there's so much new technology around immuno-oncology, even around asthma, or around things like MS, or robotic surgery. All those things are examples of disruption. And technology is often the gold standard of what drives disruption. But it can also be things like, changes in consumer behavior. One of the big things we've really seen, it's actually accelerated, I would say, in COVID is, or maybe it's a bit binomial, you either you are or you aren't. And that's caring about your health and wellness. That's been a huge, headwind for some companies, like a Kellogg in the consumer space, but it's been a tailwind for companies that have, plant-based foods in their portfolios. It's been a headwind for Coca-Cola because of sugar. But how do they adapt to that? One of the really interesting things about Coca-Cola is that they've still grown their revenues, because now they just sell 200 ml cans at the same price they used to sell 600 ml bottles, and people go, okay, that's a treat. No, I'll have that, and it's got no sugar now anyway. So disruption can happen in lots of different ways, and the trend of how that business is going to evolve over time is another pillar of what we look at. We also look at business risk. And that's really around that shape of that distribution curve. How predictable is this business? What are the key risks that this company faces? Is it economic? Is it related to, competitive tensions?
And so what are some in the current climate? Is ESG, is that sort of a potential risk that you couldn't look at currently, given what the market looks like?
Absolutely is one of those things that we're looking at within that business risk. And people sort of go, ESG is this separate thing, but it's actually not. If you think of, the impact of data privacy on Facebook, data privacy is a social issue. It's a social risk, but it's also a key risk for Facebook and for Google. And what you've seen play out for those companies is Facebook has had to invest incremental billions and, take their margins down, ultimately from the 40% range to the 30% range, in order to fulfill, that risk, in order to, put more money into monitoring their platform, in order to pay fines, in order to, invest in AI that will help them. And of course, there's been a huge upswing in the number of people they've employed to do it as well. That's an ESG risk that has played out in a true sense for that business. But I would say in many ways, the risk has made the business stronger because the amount of money that is required to monitor the platform at an appropriate standard, to take terrorism content off, to take, things that shouldn't be on there off. In Germany, for example, specifically, you must take, Nazi type content off. And they've had to build the technology in order to do that. As you can imagine, at a rapid clip, they publish stats where, it's literally millions and billions of different things that they are removing from their platform each and every day and over the course of weeks and months. And that creates an economy of scale because it's hard for another player to actually replicate what they do just from a capital and scale point of view. So it's a risk, they're managing it. It has been negative for their economics for a period of time, but it also strengthens the business. So there's a nuance in the way that we might look at that. And you'd think of, an ESG risk around the environment for a company like Nestle or a Unilever. And what you're seeing is customers care about this. Changes in consumer behaviour actually do impact future outcomes. It's a form of disruption from my point of view. So you've got, Smarties is going to have all recyclable packaging, for the first time, and that's been rolled out. You've got investment in plant-based substitutes. You've got investment in, meat-based substitutes, etc. as well. And you've had investment in, low sugar products. And unfortunately, some companies are a little bit dead in the water and a little bit stuck because what they happen to produce is sugary cereals. But again, it's important to distinguish there which are the companies that are truly vulnerable and which are the ones that are actually going to be okay. And one of the, not so much a shortcut, but where people are really doing health and wellness is in their main meals and less so in their snacks, in their sort of social occasions. So they're still, drinking alcohol. They may be drinking less, but they're drinking better and more expensive, essentially. And their main meals have shifted to being healthier, but then the snacks category and the coffee category and the high-end chocolate category have continued to grow unabated because people still, want a bit of a treat. And so it's that the subtleties of those consumer behaviour changes that can really influence, outcomes for companies over time. One of the big things we talked about is, what has e-commerce done to a lot of those companies as well? It's really leveled the playing field. Anyone can start up a brand. Anyone can sell it on social media and employ like an influencer to sell it. And has that genuinely reduced the economic moat of these companies, or does scale still matter? And again, it really depends on the category, on the type of business this company is in to make that judgment. So it's a qualitative assessment we're doing there.
In terms of that ESG thematic, do you think from an investor's point of view, it's important? Now, everyone's somewhere on the continuum of, the world's going to end in 2 years because human beings are bad, to ESGs are wrought and a way for the EU to commit to a fiscal spending program. Is it important to note that it doesn't really matter what your personal bias is that it is coming, and to not invest just on where you may sit in that philosophical continuum, but more just to recognize that whether you're into it or not, it's coming and it is going to shape the world and how capital is allocated for the next 10, 20 years.
And I think that's a really astute comment. You're quite right that ESG can be so fraught for exactly that reason, because people do put their personal opinion overlay, and it is, I suppose it is appealing to people to be able to say, well, I'm investing in line with my moral compass, but my moral compass might be different to yours,
Yeah.
and different to person number 3. And so, what we try and really bring it back to is, how does ESG risk, because it's a risk ultimately for these businesses, impact how capital will be deployed, and how does it impact the cash flows of this business? How is it going to change what this business is worth over time? Is it through, data privacy related fines? Is it because taxation in the alcohol space? And of course, there is an element of, with ESG, these things must be excluded, from an ESG perspective, a lot of, and of course we would do a bespoke mandate if there was a religious organisation that wanted to, not have alcohol stocks or not have certain type of business in there.
Provided they had a pretty big checkbook, I assume.
I suppose that's relevant as well. But you're right, like this is something, decarbonisation is another element here in ESG that companies can't hide from anymore. And it is coming. It is a genuine risk for these companies. We try and identify not just, ticking the box or, oh yes, there's environment risk or there's social risk. It's going, what is the impact of this risk on this business? What is the materiality of this risk? It might be, and a good example is something like a palm oil, which is, orangutan forests are being destroyed because of palm oil over the course of time. Consumers and governments alike are going to expect substitution away from that. And palm oil is actually this amazing product that enables you to make silky shampoo and Nutella and all these different things. They're going to have to find an alternative, and that's going to cost money and resources to do. So it's sort of, again, trying to bring it back to the economics of these businesses rather than just applying a morality sort of grey zone over and that way we're also applying it consistently as well. So it's, I personally happen to, like alcohol companies, or I personally happen to like, a Facebook type thing, because of course everyone's going to have a different view. And so we take it back to those fundamentals, the business fundamentals, because again, the objective here is to still achieve investment returns. And that's our process, and it's integrated with our risk framework.
The other thing I wanted to come back to there, which you touched on, and just to, I don't want to repeat what you said, but just to give myself some clarity on it, is you spoke about the power of scale that some businesses have. But I think you also sort of touched on, if you look at Blockbuster Video, they had scale, and that was an economic advantage. There was a Blockbuster in every neighborhood, and if you were a local video shop, it was hard to really compete with that scale. But once they got disrupted, that scale became a real vulnerability, and something that was at once a strength all of a sudden becomes the noose around their neck, and they can't compete with the company that disrupted them. Are they some of the changes and the nuance that you're sort of looking out for?
That's right. I mean, having a high fixed cost base, Blockbuster is a classic example of, retail is expensive to run. And that's why digital could disrupt it, right? Because if you've got a digital product, like Netflix, you don't have to manufacture it. You don't have to, you do have to manufacture a TV show, obviously, and, you've got to employ actors and everything. But you don't have to ship it around the world. You don't have to create distribution centers. You don't have to create a store network. You don't have to employ all these people to work in the store and run the electricity and everything. And unfortunately, what happens with those very high fixed cost businesses, and you've seen it a lot in retail, Blockbuster is a good example, is the sales actually don't have to fall all that much for the economics to start to unravel. So you're sort of in a situation where, sales fall 5% and profit falls 25%, because you can't change your cost fast enough for how fast your revenues are coming down. And that's actually a real risk, for those traditional businesses that are really high cost driven. absolutely, that's one of the nuances, and that's why having a genuine advantage is important. What protected Blockbuster, what didn't protect Blockbuster rather, may well protect sort of a Costco, because no one can, there's no gap there for someone to come in and fill. This is the thing. What is disruption? A lot of people talk about, well, trendy gins, for example, are disrupting traditional alcohol brands. And you might say, well, are they really? Because what they're doing is adding a more expensive tier to what's already there. They're increasing interest in the category. They're generating pricing power in the category. And by the way, if they're successful, the large brand's probably going to buy it anyway. And that's not necessarily disruption, because the economics of that category and of that business haven't been dismantled by that new entrant.
I do feel my initiation into Lark whiskey, though, was a complete disruption to any other whiskies across the market. So I may have to take the other side of the view on that.
I'm sure it's interesting because it's come a lot later in the dark spirit side, because it's harder to do.
Is it? Yeah, okay.
Store it, and you've got to, it's a different supply chain.
Yeah.
On the other hand, if someone comes along, and the classic example is the Dollar Shave Club, when you razors for $1, and previously there was, you're paying $13 for a packet of new razors at Gillette. That was, and that was a premium offering that some people wanted, but it wasn't one that appealed to everybody, and that left a gap in the bottom end. And that's sort of what I often talk about with something, like an Amazon or like a Facebook or a Microsoft. There's no gap there. You can use Facebook for free already. Microsoft is adaptable to whatever your needs happen to be, and cloud really makes that happen in a scale way as well. So of course, there's always a chance that there's other disruptive, enterprises that come along, but where's the gap for that disruption in place? And that's sort of part of the nuance as well. And then the last criteria that we use is reinvestment potential. It's probably one of my favorite criteria, because what is the compounding capacity of this company? Over the course of time, compounding is a wonderful thing. The power of that each and every year over the course of 10 and 20 years is a wealth building model.
And that's, if you're people who read Warren Buffett's books, that's really where they got smacked with Amazon, isn't it? Because for all intents and purposes, it barely had a PE, yet was just pumping all its free cash flow back into its business and increasing that economic moat year after year.
Absolutely. And what a wonderful example of reinvestment potential.
Yeah.
Because of the money that they generated, they plowed back in. They didn't raise capital from markets each and every year. It was all the money that was being generated by the business model itself, plowed back in. And of course, when they eventually did split out, AWS from the retail, you saw how profitable AWS was, and that, therefore the firepower they had, to really win in retail as well.
And just a huge addressable market where that ability to keep reinvesting year after year was enormous. Well, and still is now, isn't it?
And still is. I mean, if you think about it, they only really dominate in the US so far, but Amazon's market share of US retailing is 5%. They've got about 50% share of e-commerce, which is, pre-COVID was about 10%. Obviously now it's gone up thanks to necessity, and everyone's grandmothers have tried online shopping for the first time. So it's really brought that forward, and Amazon is, in the prime position, not to pun intended, to take advantage of that. But that's a classic reinvestment potential business. And it's not just what is the growth of the business, but can you put more capital into the business to generate more growth? And there's many an example of a company, Visa Card, where you actually don't need to put a lot of capital in to generate the growth. And that's wonderful. That's more valuable than a company where you've got to reinvest 100% of your capital to get the same growth. So you're not looking at just the growth, but also what's the capital intensity of that growth. Having an opportunity to invest capital is wonderful as well. And it's valuable over time, and it's definitely better than having no opportunities, because then you're better off just handing the money back to shareholders through dividends. And, that's valuable as well, but it's not as valuable as a business that can really compound for you over time.
And talk me through Magellan. You've spoken a lot about disruption, and you guys are renowned for investing in highly disruptive companies and doing it really well. that's not always associated with huge funds, particularly in Australia, where often large funds are maybe associated with more traditional style businesses. How do you marry up the cultural side of things at Magellan? What is it about the culture there that enables you to embrace disruption and innovation so well?
Oh, look, I think it's the thirst for learning. We've got, I wouldn't say necessarily by design, but we've always employed very intelligent, curious people, and with the diverse backgrounds as well. I think everyone can have their own unique perspective. And what I would say is our approach is really about being as thorough as possible. We call it inch wide and mile deep. We want to be experts in the stocks we cover. Each of our analysts, covers a minimal number of stocks. I know back in the day when I worked in the Aussie market, pre-Magellan, you are sort of spread more thin, you're trying to cover 15 plus stocks. Our analysts are covering less than 10 always, 5 to 8 often. And they have genuine expertise, in the businesses that they look at. And the other thing that's, maybe this comes from my actuarial background as well, but that distribution curve really matters. You've got a forecast and you've got a model that's telling you that this business is going to be great and it's really cheap. But what about the rest of the distribution curve? All of those things have a probability attached to them as well. So we spend probably just as much time, if not more time, on where we might be wrong, as well as where we are going to be right. And therefore, what are the holes in the investment thesis? What are those disruptive forces? What are the risks that could make this business unravel? And we explicitly, through our analyst team, identify what those are ahead of time and try and understand them and understand how predictable they might be as well. So it's that culture of always questioning what we know and being willing to change our minds on businesses.
How much does price action help you with that? What if there's a strong consensus view in the market and the price action is doing something wildly different? It's a broad generalized question, but do you generally intuitively look to back the price action or do you back consensus?
No, look, I think what we want to do is understand why that's happening.
Yeah. Anytime price action's happening that's non-consensus, it's something to explore. It could be consensus could be one thing and the price action's doing the complete opposite on the upside. Is that sort of how you look at it?
I think it's also, what is our conviction around that business quality as well? It comes into it. Is this going to be, I suppose, a temporary speed hump or a mere flesh wound that this business, because of its quality, will ultimately brush off and come through? Or is this actually more than that? Is this something that's existential to this company that we just hadn't anticipated prior? Does this change our view on quality? We often go back to, is this business as high quality as we thought it was? Is the moat as strong as we thought it was? If it is, obviously that requires a lot of judgment, then we're probably likely to buy more of that business. But sometimes there has been examples in the past where something's happened and you thought, hang on, this is actually changing the future for this company and we should shy away. So it really does depend on the company. But the price action, the market is telling you something. There's many a stock that looks really, really cheap. There's many an investor that will go down that value route of this has got a wonderfully high dividend yield or a wonderfully high free cash flow yield. But I always say, what is the market telling you about this stock? What are the warts on this company? And are they warts that, prevent you from ever finding your Prince Charming? Or are they, are they going to get through it? And the market's always giving you information. Sometimes that information is just pure noise. And, the voting machine element of, Tesla's going to sell every car to everybody all over the world. And there's going to be no competition in electric cars or, or renewables. And I think there's that type of noise. And there's equally something where, maybe something has shifted. And you've seen a few examples of it. I'll give an example of, Target, I think it was 2014 or 2013, where, they had this profit warning, their earnings were going to come down by $1 billion at the time. It was very significant. It was this classic negative 5% sales, negative 25% profit impact. And at the time, you have to do a lot of soul searching of, is this a sign of a broader headwind that retail is facing. How will this business compete in an Amazon world where, that's the thing that Amazon keeps doing because they keep plowing capital, is they're changing the cost to play. If you want to play this game in this market servicing this customer, then this is the new expectation of what you have to deliver.
Bezos's line of "your margin is my opportunity" just has a bit of a psycho feel to it, doesn't it? If you're competing against it.
I don't usually use that line because it does sound a bit psycho. Essentially, how are these guys going to compete? Do they have the cash flow to compete?
Yeah.
The balance sheet to compete, and can they, even if they try? And so sometimes those sort of price reactions are telling you something. Sometimes it could just be, and you're sort of starting to see it in a few cases now with this latest result season. The good news is sold off because it's all in the price now. Sometimes genuinely the market's just saying that stock's expensive now. And, hopefully we're not in it at that time.
And you mentioned quality stocks before, and I've spoken to the people at Magellan. They say there's one portfolio you're in charge of which you refuse to relinquish any control over, and that's the luxury market. Okay, is that for investment purposes, or are there some purchases involved in researching that mean it's more amenable to stay in control of that?
Look, well, as I did say, we do try and be experts in the stocks that we cover, and that's part of our culture as well. That everybody covers stocks, no matter what your title is or your position or whether you are running a portfolio. So everybody has sector expertise. And everyone continues to cover stocks, which I think it creates, it just creates a flatter culture. If I'm as head of research, asking the analyst team to do something, I'm also doing that thing, for the stocks that I cover.
And what's happening in the luxury market? What's your view?
So, for luxury, it's been a fascinating ride in the last couple of years, with this COVID outcome. We're very much riding high pre-COVID. The Chinese consumer has been so instrumental to growth in that sector. 20 years ago, the Chinese consumer was 1% of the luxury market worldwide. Now, the Chinese consumer is upwards of 35%.
Wow.
So that's a 30% plus, compound growth rate. And then, of course, you sort of had the stalwart shoppers, in developed markets as well. And, this is ultimately still a niche industry, as large as the companies that within it are. It's not for everyone. And you do have, this sort of half the consumers which are just outright wealthy and will continue to buy the products, regardless of what economic cycles are doing. But you do also have the 50% that's, economically sensitive, let's say. So you've seen, though, in the last year, you've seen a remarkable shape, really, because what you saw in the last year was that potentially economies were heavily impacted, service economy, restaurant sector, heavily impacted by COVID. But meanwhile, you had all the white collar workers going home and doing the same job they always did at home and adapting, I guess, to the new environment. And then meanwhile, unable to spend money on holidays and travel and things like that. And what you really saw was this, I think it was first talked about by the EU, this K-shape in the recovery, where you do have this whole, portion of the economy that's been, devastated. If you think of the out of home, bar sector and things like that, restaurants in Europe just been decimated. Typically you have a lot of people going out of business in that sector as it is, but that's accelerated and it takes a long time for that entrepreneurship to come back. But meanwhile, home renovations are through the roof. Lowe's, one of the big home improvement retailer, said in their full year result in February that they had 7 years worth of refurbishment activity take place in the last year.
Wow. So do you look through that? How do you, with the luxury trend, for instance, so people haven't been able to spend on services, they've put it into goods that are actually physical. Do you say once those services are coming back, which is starting to happen overseas, has been happening all along, well, not all along in Australia, but coming back in all parts of Australia now, what's going to happen in terms of those purchases? Do you think those things have just been brought forward, or do you think we are on a secular shift where spending on goods is going to increase again?
It's a really good question because we don't know the answer. But certainly in the case of Lowe's and Home Depot, could it keep going as long as lockdowns stay on and people decide they actually do need a better house? It could carry on for another year or so, but beyond that, you'd expect a normalisation.
If work from home's a secular change, it could keep going. Is that fair? If people all of a sudden don't need to live in major cities, but they need to live, or they choose to live in regional areas where you do build a big house instead of a small flat.
Right, that's right. That's, what is the, you've seen a huge upswing in, property prices, away from the city, even in upstate New York and parts of the US as well. So those guys expect a moderation. They've talked to the market saying they expect a moderation, but certainly it could keep going slightly longer than what people expect, because obviously 7 years worth, it's not the whole pipeline that got done. It's just a very big chunk of the pipeline that got done. And then, in luxury, it's an interesting one because historically, pre-COVID, 40% of all luxury spending used to happen when people were traveling overseas.
40%. Wow.
So that includes airports as well.
Are they selling online now for companies like Louis Vuitton and Gucci? Because they were often not big online sellers, weren't they? Absolutely
right. A lot of these companies, and I think this is a broader COVID trend, companies have had to come to the party with digital. Digital has become part of many people's lives that maybe wasn't before. We've all pivoted to doing Zoom calls. If you think of, 18 months ago, doing a video conference with someone was an absolute nuisance. It never worked. Somebody's audio wasn't working. Somebody wasn't ready. And the world has moved.
But now it's like you can't make a phone call all of a sudden. Everyone wants to Zoom all the time. There's nothing wrong with just a phone call.
Sometimes I don't want to answer that. I'm not camera ready.
Yeah.
So I agree with that. But, that's been brought forward. Microsoft Teams, cloud-based computing's been brought forward. E-commerce, in the peak of the crisis, e-commerce, for some of these luxury companies was 100% of their sales, where previously they really dug their heels in and thought, no, our store experience is the important thing. And nonetheless, the store experience is still going to be important for companies like that. But do you really, once you've set up your online grocery shopping, maybe going to the supermarket isn't so important to you, and so these things have permanently shifted and been brought forward. It's not to say that never would have happened in 10 years and 20 years time, but it's happened now. There's been an exogenous force that's brought it all forward. And even casualization, I sort of have a bit tongue in cheek, but Nike is one of the most best performers in 2020 as well, thanks to that shift to, gosh, I'm going to need a whole new suite of tracksuit pants for my work at home life. So that was already something that was happening, interestingly enough. People were becoming more casual in their attire.
And I've noticed even people going back into the office, they don't get as dressed up as they did pre-COVID, I don't think.
Right. I do still, but...
Yeah, you're the exception to the rule. That's why you've got the luxury portfolio.
So it's an interesting one, because once you can travel again, go to the restaurants again, there's some things that probably aren't repeat. If you didn't buy a handbag this year, you might not buy two next year. If you didn't get, but there's other things, sort of, if you didn't get married last year, you are likely to get married next year. Or if you didn't renovate your house last year, you might do it next year. So it really depends on the sector in terms of what might happen. One thing that's really interesting is this pivot in luxury. Overall sales are now up. So for LVMH, which is Louis Vuitton, Moët Hennessy, their fashion and leather goods sales in this first quarter just gone were up 37% on 2019. So that's that size of that, I want something to spend my money on type dynamic.
Does it correlate to equity markets and asset prices as well?
Absolutely, it does. And it does depend on the consumer. So in the US, the wealth effect of the share market is very obvious. You tend to see a really high correlation. Cognac and champagne sales have gone through the roof in the US, as have luxury sales. In China, it tends to be more around property markets or entrepreneurship, IPOs. Those types of things tend to be more relevant. And then in Europe, it tends to just be the stalwart wealth. That's in there. So there's a bit of judgment there around, yes, it's actually not surprising that luxury has done so well in the context of markets and in the context of people being at home. And you do need to sort of factor in a bit of a tempering there. And the fact that if people travel again, they potentially have less money to allocate to this type of spending in the future. But nonetheless, it'll continue to be, the enduring appeal is part of the moat as well. So there's a lot of little subtleties there in terms of understanding that sector. But that's an example of businesses that have that structural growth tailwind sitting behind them. That Chinese consumer is still, in its infancy in terms of its, the ability to spend. I say it's sort of 35% plus of the luxury sector today, but that affluent class, it's only a small number of people, but that's expected to grow in the next 5 and 10 years, still at 20% per annum.
And it looks like the government's really trying to transform their economy into a consumption economy as opposed to just a factory for the world. Is that
That's
fair?
Right. 100%. It's, I think it's actually part of the Chinese Communist Party's social contract. You keep us in power, we'll make sure that you have a great life. And obviously people who are happy in their life are less likely to have issues with the way the government's running things as well. So I think creating wealth and creating a high standard of living among the Chinese consumer is a key objective. And one of their objectives, for example, is to have zero unemployment. They want people to be productive and consuming, developing things like Hainan in place of Hong Kong as a place to travel to and spend money. The support ultimately of the large e-commerce platforms, like Alibaba, as much as there's been a lot of hoo-ha about that, ultimately they are still among the most powerful platform in China. And
are you comfortable investing in those businesses, given when you invest in it, you're not buying the business, you're buying legal obligations that are set up in America? I mean, I'm not smart enough to understand what it exactly is, but you're comfortable, obviously, with making that leap of faith?
Yeah, look, so we have spent a lot of time, interrogating the variable interest entities. There is obviously, complex legalities between those, which I don't necessarily need to bore people with. But
the Judd Family Trust, it was a bit challenging for us to get my head around it.
It is also a function of face here. There's a very large cohort of foreign investors. Baba is listed in the US. And obviously there's a Hong Kong listing and stuff as well now. And I think there is a face-saving issue around the investors, getting what they expect to get.
And China's incentivized to keep getting those US dollars into the Chinese system. It doesn't really play into China's interest to screw over those investors and preclude future IPOs from happening where they can bring USD into the country. Is that fair?
And that's right. I think, the Chinese consumer and certainly the population is very much benefiting from the ongoing investment of Starbucks, of LVMH, of Nike, and McDonald's, and the list goes. And Apple, of course, that's another good example. So look, there is a bit of a symbiosis, and the way I was going to answer your question as well is really about that symbiosis and that sort of political frenemy situation that exists between China and the US. And it's interesting because Trump completely changed. He did it a different way. He did it in his own way, throwing grenades. And it was interesting because the CCP have a long-term plan. They don't necessarily need to worry about a president who's only going to be around for 4 years. They can wait him out. But ultimately, the two countries need each other, and they mutually benefit from each other's relative competitive advantages. But at the same time, both countries want to succeed and dominate over time. And one of the key ways, particularly if you look at the long-term plans of the CCP, and certainly it's applicable to the US as well, is technology dominance becomes really important in that. If you're going to be the leader in space exploration and deep sea exploration and artificial intelligence, then you need to be a technology leader. And that takes a significant amount of capital. And I think that's always, from my perspective, in the back of the minds of the governments that want to regulate these businesses, because you don't want to weaken them. You actually still want your country to win over the next 10 years and 20 years and 50 years. And, dethroning those companies could actually, you're shooting yourself in the foot potentially as well. And you saw that with, the Alibaba. There was so much hoo-ha about they're going to be regulated. And I think there's no doubt they will be regulated. For example, they've been told they're not allowed to make merchants only sell through them, and if they ever dare to sell through PDD or JD, we're gonna make life hard for you. They're not allowed to do that. Sure, that's a competitive issue, but the fine that they got was mere change, really, relative to the 70 billion, that they've got sitting there on their balance sheet. And this is a business that, yes, is going to be impacted by regulation. You've seen it in the case of Facebook and Google in terms of their fines and actions as well. But ultimately, it's a business that the CCP wants to succeed. So it's more just, let's work together, and we are, to make sure that you do what we want you to do, which is be successful, and give us as a government also that firepower over time. And that, there is an element of comfort that I take from that as well. In the case of Alipay, you're going to have, I think the risk with Alipay, obviously Jack Ma shouldn't have said what he said. He should have known better, probably, being someone, a Chinese national. Surely you've been here before, mate, kind of thing. What it created, and what the interesting difference for something like an Alipay is that they were doing a lot of financial transactions, on their system. And that was taking that important part of the economy away from the banking system, which is controlled by the CCP. And I think it's inevitable that the CCP would want to regulate that and be in control of that, the movement of money, in their country. So I think it's always a nuanced decision and a nuanced analysis that really needs to go into working out which are the vulnerable businesses and then which are the ones that are actually likely to thrive because they've got inherent support.
It's brilliant. Well, I won't take you down the whole China rabbit hole because I reckon I'll need another hour to ask you everything I'd want to learn about it. But I think that's a brilliant place to stop. I really appreciate your time, Vihari. I've loved the chat and look forward to following Magellan's progress.
Yeah, thanks so much, Chris. It was a great chat as well.
Awesome. Thanks, Vihari.
This episode of Masters of the Market is proudly brought to you by AIA Health with AIA Vitality, health insurance that protects and rewards. To find out more, visit aiahealth.com.au. If you're enjoying Masters of the Market, make sure you subscribe to Chris Judd Invest.